Hey everybody, I hope everyone is doing well and had a good day. In today's video, we're going to review the E-mini S&P 500 5-minute chart for Monday, July 6th, 2026. Here's the daily chart as we go into the day. The market is in a trading range or a bull channel, and either way, the expectation is that there's sellers as we get closer to the top of the range. We had this micro channel here, a pullback. This is July 2nd. And the expectation, most of the time, breakouts, micro channels like this get second legs, usually similar in size to the micro channel. In other words, leg one, pullback, leg two. That leg two target brings us to a new high. From the 2nd of July close, this would require about a 140-point move. The recent average daily range has been about 100 points, so I don't expect to get up here today, but I do think we're going at least a little bit higher. This looks like a micro channel, minor reversal, pullback, buyers below. It's a weak sell signal, and then probably going at least a little bit higher as the bulls get their second leg, but then probably sellers at the all-time high and the leg two measured move. Okay, here's the 5-minute chart. You look back at July 2nd, there was a gap up, a trading range, and then another gap up going into today. Bar one, it's a bull breakout bar, but relatively small body. The body makes up maybe half the bar's range and big tails. So there's trading range behavior in bar one. Also, bar one usually does not remain the high or the low of the day. So the expectation is we're probably going to go above and below bar one. But it looks like with the gap up and a follow through bar, with bar one being a bull bar, far above these bars to the left, relatively tight trading range, this is good for the bulls, breaking far above the bars to the left. And that's probably going to create trapped traders below and a second leg up. So where are the trapped traders? Maybe at the half day's close or the high of this range, probably support somewhere in this area, and also below bar one. So bar two, bear breakout bar, but big tail. Looks like there's a lot of buying into the close of the bar near these areas of support. Bar two is a big enough surprise that it'll probably create resistance above the bar, sellers above, and get some kind of maybe attempt at a second leg sideways to down. But the gap up and follow through buying on bar one also needs a second leg. So looking like a trading range on the open. Finding support down here, reversing up and then getting a couple of bull bars, 3 and 4. But as we get closer to the close of bar one, the high of bar two, there's probably resistance here, sellers above. And if we get above bar one, probably sellers above. Again, it looks like a trading range on the open. So the market reaches a new high for the day on bar 5 and finds sellers above. It looks like a limit order market, sellers above 5, probably buyers below 5, scaling in lower below bar 2. Trading range continuing here with an inside bar. Bar 6, probably sellers above and buyers below, but this is just about the middle of the range, not ideal for trading here. Better to sell higher and buy lower. Trading range bar 7, probably buyers below and sellers above. A lot of overlap here on the open, so the trading range continuing, limit order market. Again, sellers probably above and buyers below. Bull breakout bar on 9, so 3-bar micro channel, 7, 8, and 9. Still probably a limit order market, which means it's a reasonable thing for sellers to come in above bar 1, above bar 5, selling here on bar 9. But because of the 3-bar micro channel and bar 9 is a pretty strong breakout bar, there might be enough momentum here that the bulls will get a second leg. So hesitating on bar 10, and it might be 3 legs up, you can count. Bar 1, pullback, bar 5, pullback, and then bar 9. That's 3 tests of resistance. So do you sell below bar 10? It's a low probability sell below bar 10. With the 3-bar micro channel, I said earlier on the daily chart, most breakouts, most micro channels get second legs in the direction of the breakout. So here, 3-bar micro channel from the low of bar 7 to the close of bar 9. The bulls will probably get a second leg in the direction of the micro channel, a second leg up. Bar 10 is a relatively small bar. There's a tail below the bar. And all the bars have been above the moving average today. So technically the market is channeling up here with higher lows and higher highs. So there might be more traders buying below bar 10. And as far as selling pressure so far, because if you make the wedge argument, 3 legs up, well, what about the selling pressure? And it is true that there's sellers above bar 1, sellers near the high of bar 5, but where are the consecutive strong bear bars? Through here, they don't exist. Also, the higher time frame context, think about the daily chart. From the close of July 2nd, there's a fairly big gap up going into the day, and a gap up it functions the same as a bull breakout, and breakouts usually get second legs. So the bulls, it's a trading range on the open so far, but the bulls are looking to get a second leg up, and so far the selling pressure has not been strong enough to expect a major reversal. So it's either probably going sideways or up so far today. That's what the evidence on the chart is suggesting. There can always be a surprise, of course, but up to now, the bears have not done enough for anything major. Micro channel continuing here on bar 11. So good for the bulls, second leg up likely as we break out to a new high, and we get follow through, so that's good for the bulls. Bar 12 is a relatively small bar, and now we've had a bull breakout, a pause on bar 10, and a second push up to bar 12. So the traders buying bar 12, they are buying momentum. They're not buying value. They're buying far above the moving average. And it still applies. Most breakouts get second legs. Most micro channels get second legs. This is a micro channel from the low of bar 7 to the close of bar 12. So expect a second leg up. But as we get further from the moving average, traders, the problem for the bulls right now buying bar 12, in theory, their stop is below bar 7. The risk is getting big. The stop is far. So traders can reduce their risk or decrease their risk by reducing their position size. So taking some profits, especially if we start to lose momentum. And bar 12 is a smaller bar than 8, 9, and 11. If you do buy bar 12, your two options are to exit early on any sign of losing momentum, which buying bar 12 is already a sign of lost momentum. It's a smaller bar, and it's not an ideal location for losing momentum when you're far above the moving average, because your premise is that you're buying momentum. But if you do buy bar 12, you do not put your stop below bar 12, because remember, a second leg up is likely, so expect a pullback, minor reversal, and then a second leg up. So if anything, there might be more traders buying below 12. If you're going to buy here, buy small and use the correct stop, which is at least below bar 7. Bear reversal bar 13. It's a strong looking bar, but it's maybe an average size bar, not especially big. Because we're far above the moving average and it's a bear bar closing on its low, it's reasonable to exit longs below it, but it's still always in long with the decent momentum, 7 through 13, a micro channel. So I think it's okay to exit longs below 13, but be willing and ready to re-enter the market long if you get a bull bar closing above its midpoint. 13 is probably strong enough for maybe a small second leg sideways to down, but do not expect a major reversal from 13. It's one of those situations where you've got great risk reward selling 13, relatively small bar, and big possible reward. So small risk, big reward. But whenever you see a trade with a good risk reward profile, you know it has low probability. And the opposite side of the trade has higher probability, and the bulls have that higher probability. Momentum, micro channel to bar 12, probably buyers below, and a second leg up, likely. Trading range, bar 14, maybe more sellers above 14. The buy the closed bulls on 12, trapped, disappointed with 13 and 14, so there might be sellers here. And then 15, a bear breakout bar, but reversing and closing above its midpoint. If you look at a lower time frame chart, like the 1 minute chart, what you're probably going to see is a spike and parabolic wedge bear channel. So bar 13 is a spike. The market pulled back to the high of bar 14, began channeling lower, and then 15 clearly breaking below the channel line, far below the channel line, or relatively far below the channel line. Especially you'll see this on the lower time frame. It's also testing support. You look to the left, and it's the bull breakout and then a pause. This is a trading range on the lower time frame. So it's basically a bull trend, trading range, bull trend. The market's coming back and testing that trading range where traders got trapped on 11 and 12. So for the bears, structurally, they have a completed structure, spike and channel, parabolic wedge, overshoot of the channel line, testing support, and you still expect a second leg up from this micro channel to bar 12, which the bulls have not had yet. Trading range bar 16. It's always in long, reasonable to be long, expecting that second leg up, and 13 got its scalp. 13 got its second leg down. So it's hard to make an argument for being short here, with the selling pressure being as weak as it is, and with this micro channel being as strong as it is, expecting that second leg. It's better to be long. Another micro channel to 16, 17, probably buyers below, maybe buy the close. 18 breaking out to a new high, so you expect the market is now in the channel phase. You expect sellers above 13, so 18 breaking out, and we're pausing, getting a pause bar on 19, but the micro channel continuing. So the bulls, another micro channel 15 through 19, expect a second leg up, and this looks like a minor reversal, maybe more buyers below 19. Another good risk reward situation for selling below 19, but bad context. Micro channel continues. We finally fall below a bar and pull back on 21, but it's another micro channel in a bull trend. Micro channel trading range. This is at least 2 pushes down, maybe 3 pushes down to 21. And there's probably support here. Bull breakout, trading range through here, and then another bull breakout. So the traders selling on the lower time frame, this is the trading range, and the traders selling here getting trapped by the bull breakout. The rally traps traders below. That creates support, which is being tested here on 22. It's also testing near the moving average. Now you can count at least 3 legs down, maybe even 4 legs down. But here I see, here's one push, a second push, and a third push down to support. And again, most breakouts get second legs. This is a micro channel breakout from 15 to 18. Expect a second leg up. The bulls have not had it yet, and the bears have a completed structure, 3 legs down to support, probably buyers below 22 if we get there, but it's a reversal bar closing above its midpoint. It's a reasonable stop order buy. Yes, you're buying near the high of the day, but it's a possible double bottom, bull flag, and a bull trend. It's a tight bull channel with relatively weak selling pressure, still always in long. Breakout bar 23. So a bull breakout bar, it's a with trend breakout. It's a breakout in the direction of the trend, reasonable to buy here. Hard to make an argument for selling, and when that's the case, you know it's okay to be long. And then a breakout bar 24, good breakout bar for the bulls, very little overlap. Bull bar closing on its high, far above all the bars to the left. Isn't it a wedge with at least 3 legs, maybe 4 legs up? yes, this is not an ideal place to be buying, but it's another micro channel in the direction of the trend, 22 through 24. So expect a second leg up. So maybe buying here is not ideal, but buying a pullback is reasonable. There's a gap from the close of the breakout bar to the breakout point, these highs, and that's probably going to be support if we get back here. In general, you expect channels to weaken over time. You expect sellers at the high, so 24 might be a profit-taking bar. Reversal bar 25, another good risk-reward situation, but low probability sell below the bar. So maybe there's a counter-trend scalp here, but better to just look to trade in the direction of the tight channel. It's obviously easier to make money buying here. And we trigger the sell below the bar, but testing support. So there's probably going to be buyers here. Like I said, think about the bear's perspective, or even the bull. It doesn't matter. Just think about the seller's perspective. Whether you're a seller, you're a bear initiating shorts, or if you're a bull taking profits on longs, it doesn't matter where you bought. Just imagine you bought anywhere and the market's breaking out to a new high in the channel. So you decide to take profits at this red line, a new high of the day. And then you get bar 24 and you think, wow, price is far above this high. I could have held for higher prices. Instead, I sold way down here. So the bears who sold are trapped into a losing position. If they sold here, they're trapped into a losing position. They can scale in higher as the market tests the channel line. The bulls who took profits are trapped out of a winning trade. They wish they stayed in the trade, and they're probably looking to re-enter at support, which is this breakout point. So what happens? The market comes back and tests that area of support. Both bulls and bears buy. Bulls buy to go long, and bears are buying back shorts, maybe at their original entry at break even and at a profit on their higher scale in entries here on 26. So the market bounces there. And now we have another micro channel to bar 28. Certainly a late leg in the channel for the bulls, so it's hard to get long here, but it is a tight channel. It's a breakout on a higher time frame. If you're buying here, your two options are exit if we start to lose momentum, or use a wide stop and be willing to scale in lower. Second reversal, bar 29. The problem with reversal setups like this, so it's a tight channel, technically second entry short below 29, reasonable to exit longs below 29, but as far as selling to go short, it's still a low probability sell. Reversal patterns are, what does Al say in the books and in the video course? It's better to think about reversal patterns as continuation patterns because 80% of them fail to reverse the trend and they lead to trend resumption. They evolve into flags. So it's more likely that this is going to evolve into a bull flag and lead to trend resumption than reverse the trend into an opposite bear trend. But reasonable to exit longs below 29. As far as selling, it's a low probability sell. Tight trading range for the past 7 or 8 bars here. So limit order market, probably sellers above and buyers below. And this is becoming a lot weaker for the bulls, a lot more overlapping bars. Maybe a nested wedge, you can count 3 or 4 big legs up, and then through here, at least 3 legs up here. Even here, if you look at maybe 30 as a spike, pullback 31, and then channel at least 3 legs up here, 1, 2, 3. So there's a nested wedge. We may get more of a correction here. Exiting longs below 35 is reasonable. And then, not that the bars to the left are irrelevant, but if you just focus on these bars, this structure, it's a spike, pullback, and channel. And there's sellers above bars to the left, so this channel has a lot more overlap than back here. And this may evolve into a trading range. Most of the time, channels do evolve into a trading range, and the market comes back and tests the start of the channel. So I'm talking about here, 22 through 24 is the spike. Market pulls back to 26. The low of 26 is the bottom of the channel. Here's the channel. And now we've had at least 3 legs up in this channel. And channels usually evolve into trading ranges. And now we have a bear bar, 35. So reasonable to exit longs below 35. For bears, they have an argument that this channel should correct for a couple of legs and come back and test the low of 26. $36 bear breakout bar, good for the bears, probably going at least a little bit lower. Now it's a reversal and follow through for the bears. Why should we expect a second leg down after the breakout on 36? Because of trapped traders. In theory, there's traders buying and selling on every tick throughout the day. And so in theory, there's a trader who they see a tight bull channel. They put a limit order to buy below bar 35. They get filled on 36. And now here's their entry bar. So 36, they enter below 35. And now the price is far below their entry price, and they're holding a losing position, and they're disappointed. So the logical course of action would be exit on any bounce they can get, because the expectation, I should say, the expectation is that breakouts get second legs most of the time. 80% of breakouts get second legs in the direction of the breakout. And so with 36 obviously is a bear breakout bar, so it's no exception to the 80% rule. You have trapped traders below 35 on the breakout bar 36, so traders are expecting lower prices, a second leg down. And 36 ends up getting its leg 1 equals leg 2 measured move either on 37 or 38. Smaller time frame. So 5-minute chart, we see a 4-bar micro channel, but on the lower time frame, we would see a spike and channel structure, 3 legs down to bar 38. And it's 3 legs down to support. Look to the left, we're testing the bar 26 low. So another reasonable reversal bar 38 for buying. It's kind of like back here with bar 22. 3 legs down to support in a bull trend. Spike and channel, 3 legs down to support in a bull trend. So buying above 38 is reasonable. And then a breakout bar 39. So good for the bulls. Traders, bears probably exit shorts above 39, and bulls can buy above 39, expecting at least a test of the highs, maybe the high of bar 34. Just imagine, again, breakouts, reversals, trapped traders. In theory, a trader bought above 34, they get trapped on the reversal and follow through, 35, 36. They're disappointed. So any trader who bought up here, scaling in lower, will probably be happy to exit at their original entry back up here. 38.39 gets a second leg up on bar 40, reaches its measured move target and resistance with the bars to the left. So as strong as bar 40 is, it's not at an ideal location for buying. If anything, there might be more sellers up here. And remember, most breakouts get second legs, and the second legs are usually similar in size to the signal. So 35, 36 is a reversal and follow through signal. It's expected to get a second leg similar in size to the signal, these two bars, most of the time. Those traders who sold here are scaling in higher. They're selling more at resistance, expecting that second leg down. And then they get it on bar 41. Reversal follow through, deep pullback, second leg measured move reached on 41. 41 is a strong bar, reversal bar, but now it's testing closer to support. There's probably buyers below 40, buyers below 39, buyers down here in the lower part of this range. Breakout bar 42, but a smaller bar than 41. You can also count 3 legs down. Maybe it's an expanding triangle kind of structure with higher highs and lower lows through here. just focusing on the bear channel line, it's 3 pushes down, 3 tests of a channel line, and once again, support in an overall bull trend. Remember, tight bull channel, look at a 15-minute chart. This is a bull breakout. You expect breakouts to get second legs. So all of this is probably a minor reversal. 3 legs down to support, another possible wedge bull flag, bar 42. So 42, reversal and follow through, but late leg and counter trend, and it's at support. Bears really need a follow through bar here. And whenever that's the case, they usually don't get it. And so traders, what they'll do with bar 42, they'll take the opposite side of the trade, buy the close 42, put a stop, maybe a measured move down based on the height of these bars, betting that the breakout or that the reversal and follow through 41, 42 will fail to reach this measured move, and instead we'll get a test of the highs first. And then there's a strong breakout bar 43, wedge, bull flag 43. Good momentum, probably will get a second leg up. Maybe difficult to buy because it's near resistance. This is a trading range, and the market is testing back to the upper third of that range. But if you zoom out and think about the structure of the day, tight bull channel, trading range, and then possible trend resumption. Trend resumption is more likely after this trading range than major trend reversal. This looks like, you have to ask yourself, does this look like a major trend reversal pattern? Is there a strong break of the bull trend line? Are there big consecutive bear bars? Did we break far below the moving average? Or is it drifting sideways? And is it going to be a trading range between legs and a trend? So here's an area of trending behavior, tight bull channel, then sideways, trading range, and then expect trend resumption. So more to the upside. 44, a bull breakout bar, but testing the prior day's high. This is July 2nd high. If you think about that bar on the daily chart and think about what I said with the context on the daily chart, there might be more sellers above yesterday's high, the prior day's high. That's again July 2nd I'm referring to. So this is not an ideal place to be buying. It's also one of the biggest bars in the entire bull trend. It's a good bar for the bulls, breaking far above all the bars to the left, but the question is, can the bulls get followed through, or will there be selling at this resistance area? And 45 is bad follow through for the bulls. But the breakout 43 and 44 is strong enough to expect a second leg up. The problem is buying up here near resistance. Instead, bulls might buy a pullback. Bear breakout bar 46. So this looks like this trading range is continuing. I said it's maybe a contracting or an expanding triangle with higher highs and lower lows. Now we're testing the bull channel line and finding resistance. The bears are hoping this is a major trend reversal pattern, an expanding triangle, major trend reversal, and that this leads to an opposite trend, a bear trend. But it's unlikely. It's more likely going to remain more sideways. 4-bar micro channel down to 47, probably sellers above 47. Good for the bears, a little bit of an endless pullback here, probably going at least a little bit more down, and expect 46 to get a second leg down, and it does here on 48, micro channel continuing to grow. But as we get closer to support, we have to see, can the bears actually break far below the support, or will they take profits there, and will the bulls come in and overwhelm the bears? Another big breakout bar, 49, but right at that support area. The low of bar 26, acting as support here and here, maybe once again here, plus the bear channel line has been support here, here, and here, maybe once again here. Strong momentum for the bears. Expect a second leg down, and the first reversal attempt will probably fail. So good momentum for the bears, probably sellers above bar 50. And then another breakout bar, 51. Now we've broken far below support, but a big tail, 51. Micro channel for the bears, expect a second leg down. But when you look to the left, tight bull channel, maybe expanding triangle, major trend reversal, but the bull's point of view is expanding triangle bull flag and a test of support, a prior higher low. It's also breaking below the bear channel line. Most breakouts below channel lines fail and reverse within 5 bars. So let's see, can the bears get follow through selling here? Reversal bar 52, what I said, the first reversal attempt of this micro channel will probably fail. There's too much momentum. Sellers above 51 more likely. And we get a low one short below 53. Will bears sell below it? Will the micro channel get a second leg down? The bears are hoping the micro channel gets a second leg down, but the bulls have the tight channel through here, and they're looking for a big second leg up. Trading range over the past 4 or 5 bars. And then a big breakout bar, 55. Good for the bulls. A second reversal. First reversal, 52. Second reversal, 55. 55 is a strong enough bar at support in the direction of the major trend. You should expect a second leg up after 55. What about the bear micro channel? Shouldn't that get a second leg down as well? Everything, well, I should say, yes, most micro channels get second legs in the direction of the signal. But everything has a failure rate. Most things fail 20 to 30% of the time. But also look at the structure from 46 to 51. Breakout bar, trading range bar. So breakout, pause, a third breakout. So that's already 3 legs down on a smaller time frame. And then, like I said here, it's maybe a 4th leg down to support in the channel or the expanding triangle. And now we're getting a second reversal, 55, bull breakout bar closing on its high. So maybe the bears get a second leg down, but 55 needs a second leg up first. So it's always in long 55. And then a follow-through bar, 56, good for the bulls, probably buy the close, buy below. 55, expecting the micro channel to get a second leg up and a test of the highs, but probably resistance in this area, the high close of 44. As always, imagine trapped traders, buy the close bulls 44, disappointed by the micro channel. Whoever bought here, scaled in lower, they're probably disappointed, looking to sell back up here. And that's right near the prior day's high. But micro channel to 57, expect a second leg up. Good for the bulls. Vacuum to magnets, the close of 44, the prior day's high, once again, 58. So good for the bulls. Many consecutive bull bars. But looks like a trading range. You look to the left, and we have a lot of bars sideways, and we're testing near resistance. Pretty good momentum for the bulls, so expect at least an attempt at a second leg up. And if you're going to sell, wait for a second entry short. So do not sell 60. It's another great risk-reward trade, but low probability. But probably more traders buying below 60. 60, similar to 13 and 25. So 60 might be strong enough for its own second leg sideways to down, but that's usually the best the bears can hope for here after all this momentum is a second leg sideways to down and a scalp. And bar 61, the bears get their scalp. So 60 gets a second leg down, 61. Reversal and follow through, 60, 61. Maybe that gets a second leg down as well. But again, remember, after all this momentum, better to wait for a second entry short if you're going to sell. Now the bears have a reversal, a pullback, and a second leg down, and approaching support. 57 inside bar trading range. So breakout, pause, another breakout. Here's a breakout point, support, probably buyers in this area. And now if you look at a lower time frame, or just imagine what the lower time frame looks like, 60, 61, 62, 3 pushes down to support, 62, maybe more of a buy the close bar, even though it's a micro channel. And most breakouts, most micro channels get second legs. You have to consider the structure of the micro channel, and this has a lot of tails and overlapping bars, and this is already a completed 3-leg structure on a lower time frame, so you can expect a correction, but also zoom out and you see a big bull breakout that's expected to get a second leg. Bull breakout 63, probably buy the close, buy a pullback, reasonable. Always in long, 64 breaking out, but channel phase, expect sellers above bar 60. But instead, the bulls break out 65 and 66, follow through buying. So this one reminds me of what I said back here. The market's in the channel phase, it breaks out to a new high. You expect sellers at the high, but instead you get a big breakout, and that creates support at the breakout point. So exact same thing here, bar 60 high. As the market is channeling higher, expect sellers above, but instead we get a breakout and follow through. Now, this red line is the breakout point. Bar 60 high, expect support here. Probably buyers below 66. Outside trading range bar, probably a minor reversal. Another micro channel expected to get a second leg up. And testing support, that breakout point. Here's another wedge bull flag. Lower time frame, it's more clear, but that's 3 pushes down to support. Bull breakout, wedge bull flag to support. Bar 69 is a buy the close bar, buy below. And then 70 breakout bar, but again, channeling higher, expect sellers at the new high. This time we break out to a new high and then get a pause bar 72. Another micro channel, this may get a second leg, but leg 3 may get a deeper, maybe 2-legged correction. Bear breakout 73, expect a second leg sideways to down, but also again, because it's now 3 legs up, may get a bigger, more complex 2-legged correction. Also for the bulls, maybe somewhere through here, it went from trading range to bull trend. Tight channel from maybe 7 to 24. So maybe that's leg 1. Then pullback, leg 2. We didn't quite get there, but that's close to a leg 1 equals leg 2 measured move with a 3-leg structure. So expect a correction near that measured move target, and because of the channel, exhausted bulls taking profits. Four-bar micro channel, bad buy signal above 74, near resistance, probably sellers above 74. 75 inside bar, but again, probably sellers above, maybe not directly above 75, but probably above 74, or somewhere around this resistance to the left. So the market breaks out above 75, finds resistance, reverses back down. Maybe this micro channel gets a second leg. It looks like it's a trading range through here. So middle of the range, not ideal for trading. The bears have a micro channel, a pullback. Maybe they get a second leg down. But probably buyers somewhere below, maybe 69 low, prior day's high. And then a big breakout bar, 77. So good bar for the bears. But for the context, possible second leg trap, 1 pullback, 2. Approaching support, remember 3 legs up, expect a 2-legged correction. Here's a 2-legged correction, 1 pullback, 2, near support. Why is the close of bar 72 support? It was 3 legs down, but in theory, 3 pushes down on the lower time frame, but in theory, there's a buyer and seller on every tick. So traders who sell the close 62, trapped by the rally. And that creates support in this area. So you can see the reaction on bar 78 as price tests support to the left. We find buyers and the market bounces. Now 78, pretty decent reversal bar, closing on its high at support. That may get a second leg up before 77 gets a second leg down. And possible second leg trap, 77. So not ideal for selling in this area anyway, but bears might sell a pullback. A pause bar for the bears, it would be 3 legs down below 79, so probably buyers below 79. Again, 78 expected to get a second leg up, which it gets here in the final couple of bars of the day. Maybe bears come in and sell this breakout point, and 77 gets another leg down, but then it would be 3 legs down to support in a trading range in a bullish environment. All right, that's going to be it for today's end of day review. Thanks everybody for watching, and for more price action fundamentals and how to trade price action, you can visit the Brooks Trading course. There's a link in the description of this video. And once again, thanks everybody for watching, and I hope everybody has a good night.